Welcome to the Explainer. So, big news. India's tax laws just got a massive rewrite. And today, we're going to break down exactly what the new Income Tax Act of 2025 means for, well, probably the most important number in your financial life, your salary.
Now, this isn't just some small tweak. We're talking about a once-in-a-generation overhaul that's designed to completely modernize India's entire tax framework. We're going to zero in on the part that really affects millions of us directly: how our salary is defined, how it's calculated, and of course, how it's taxed. Okay, so before we get into the nitty-gritty of your payslip, let's just zoom out for a second. Why was this huge change even necessary in the first place?
Well, the government basically had four main goals in mind. First, simplify all that complex old school language. Second, bring everything into the digital age. Third, make the whole system way more transparent and friendly for you, the taxpayer. And finally, get our laws in sync with today's economy, things like digital assets.
And this chart, it just nails that point about simplification. I mean, look at that. The old act was a maze of 819 sections. The new one is so much leaner, cut down to 536. The whole idea is to have a law that's just easier for everyone to get their head around. All right, let's get to the heart of it. We're now diving into Chapter 4 of the new Act. This is where the rubber meets the road for most of us, because it's all about salary income, and it all starts with the foundational rulebook, Section 15.
So, Section 15 basically sets the ground rules. It defines the exact moment your income officially becomes salary in the eyes of the tax department. And get this, it's not always when the money actually lands in your bank account.
This is a super important detail. Your salary can be taxed when it's due, even if you haven't been paid yet, or when it's paid, like in advance, even if it wasn't technically due. Whichever one of those happens first, that's when the tax clock officially starts ticking.
So the magic ingredient here is the employer-employee relationship. Any money you get from your current boss, or even a past one, counts. But the law draws a really clear line in the sand. If you're a partner in a firm, any salary or bonus you get from that firm is not taxed as salary under this specific section.
And this is absolutely key. The new act is really broad here. The word salary isn't just your base pay. Think of it more like a giant umbrella, and a whole bunch of different parts of your compensation have to fit underneath it.
And wow, when you look at Section 16, you see just how much falls under that umbrella. You've got the obvious stuff, right, like wages, but it also includes pensions, gratuity, commissions, advances, and even the cash you get for leave you didn't take. Plus, it includes two really big categories we're about to explore: perquisites and something called profits in lieu of salary.
Okay, let's keep going and see how this definition of salary gets even bigger. Now we're talking about all those extra benefits and special payments that also count as taxable income. The law uses a fancy word for all those non-cash benefits, perquisites, but you and I would probably just call them perks. It's basically anything of value that your employer gives you on top of your regular paycheck.
And Section 17 gets really specific about what counts. We're talking about the value of that company apartment, special benefits you get for cheap, and even times when your employer pays a bill that was really yours to pay. It also includes sweat equity shares. That's just a term for shares your company gives you for your hard work instead of cash. And here is a number you'll definitely want to remember from Section 17. If your employer's total contributions to your Provident Fund, your superannuation fund, and your pension schemes add up to more than 7,50,000 rupees in 1 year, anything over that limit is treated as a taxable perk.
All right, next up is Section 18, which covers profits in lieu of salary. This one sounds a bit technical, but it's actually pretty straightforward. It's a catch-all for any payments you get when your job status changes. So think about severance pay if you're laid off, a signing bonus for a new job, or even a payment you get after you've already left the company. Okay, so we've talked a lot about what gets added to your income, but now for the part everyone's been waiting for: what can you subtract to lower your final tax bill? This is all covered in Section 19. And this is the good news. The law allows for several key deductions, and this is where you can actually make a difference in your take-home pay. This table shows some of the most common ones, like the standard deduction, your full professional tax amount, and exemptions for things like voluntary retirement payments. Let's zero in on the biggest one, the one that affects pretty much every salaried person. If you're using the new default tax regime, the standard deduction is now a flat 75,000 rupees, or your total salary, whichever is less. That's a straight-up reduction of your taxable income right off the top. And this is a really big deal in the new act.
If you choose to go with a new, simpler tax regime, you get that higher standard deduction of 75,000 rupees. For everyone else, it stays at 50,000. So for a lot of people, making that switch could mean a bigger deduction and less tax to pay. Okay, so you've figured out your total salary income, you've subtracted all your deductions, but how does the government actually collect the tax that's owed? Let's walk through that final step.
It's all thanks to a system called Tax Deducted at Source, or TDS. Section 392 basically makes it your employer's legal duty to estimate your total tax for the year and then deduct a little bit of it from your pay every single month, before that money ever even gets to you. And this quote from the Institute of Chartered Accountants really sums up the whole spirit of this new act. At the end of the day, the goal behind all these new sections, from defining your salary to listing deductions, is to create a system that's just simpler and more straightforward for every single taxpayer to follow.
And one final, really important thought to leave you with. Let's say you get a big back payment of arrears or a huge advance, and it pushes your income for 1 year way up, landing you in a higher tax bracket. Well, the new law has a safety net for that. Section 157 gives you a way to apply for tax relief, so you don't get unfairly penalized just because of weird payment timing.
And that's our look at how your salary is handled under the new Income Tax Act of 2025. If you want more details or links to the official sources, just check the description below. Thanks for joining us, and we'll see you next time on The Explainer.